What perspective are you using, or what lens are you using to make sense of the external world? No? A lot of the times, if we have a growth mindset and we see potential opportunities and challenges and so on, we are likely to thrive. But if we see external events and we see ourselves as victims in relation to those external events, often we are found wanting and we are found on the back foot. We don't thrive. So this slide was really meant to say, challenge your own thinking, because your thought process influences your feelings, and your feelings will influence, if they're strong enough, they will influence physically how your body responds to those feelings. The reason why impact is so important is because all of us are communicating verbally and non-verbally in our circumstances. Only 7%, some of you will remember, only 7% of what you say to anybody is the words that you use. That means 93% of what you say is not coming out of the words. This is significant because you might say something like, I'll give you your report on Friday. Or say, I'll give you your report on Friday. That 7% in Exhibit A and Exhibit B are exactly the same. But how I postured myself would have given a different response. You will respond differently to those two sets of statements towards you. Because 38% weighs far heavier than the words. And how you mold the words weighs much heavier than the words themselves. What emotional intelligence is, I'd like you to think about it as a set of tools. Think of yourself as holding a rucksack. And in this rucksack, there's a couple of social tools that you have. In any interaction and any social context, you pull out the one tool that is most relevant for that situation. That's what emotional intelligence is. It's a set of tools that you will use as you navigate your life experiences, personally, professionally, and so on.
I'm going to jump straight into the presentation because we've got quite a bit of content to cover, and I'm going to try and go through it as quickly and efficiently as possible so that we can get through all the source material, and then we'll have a rich question and answer session right after the event. But if there is any questions, then just pop them through to the chat, and then Tim Kulu will just you will advise me if there's any pertinent questions that we just need to stop and address as we go along. So jumping straight into it. So we're going to talk a bit about financial management, right? And I think financial management is always this mystical topic. It's always understood as something that only financial professionals understand. It's complicated. You must be an accountant or you must be a financially savvy person to understand what financial management is. So I've pulled down three definitions that I think really encapsulates what financial management is. And the first one is financial management is the process of planning, organizing, and controlling a company's financial resources. And this definition was given to me by Google AI. I mean, if you don't know what AI does at this point in time, then I think I would suggest that you go and invest some time into AI and see what it's really capable of, because there's quite a few integrations where AI can be very useful to even small to medium enterprises. But this definition is very basic. Process of planning, organizing, and controlling a company's financial resources. Next definition is financial management is about controlling the flow of money in and out of an organization. So it's really, really simple, basic definitions for financial management. And then we've got another definition, which I thought really has a bit of meat to it and is more comprehensive than the first two definitions. Financial management is strategically planning how a business should earn and spend money. This includes decision about raising capital or funding, borrowing money, and budgeting. Financial management also involves setting financial goals and analyzing data. Financial management starts with recording all the money in your business earns and spends. Accountants then prepare reports that help owners understand the financial health of their business. This includes profit and loss statements, balance sheets, cash flow statements, and budgets. So this is quite a meaty definition of financial management, but we'll break it down as we go through this presentation. And this one I got from Xero. Xero is they've got quite a wealth of resources with regards to cash flow, financial planning, financial management. So it might be good to pop around to their website if you're looking for something. So why is financial management important? Because I think it's a word that is thrown around, and like I said, it does cause a bit of confusion to everyone. But financial management, and we'll see now going forward, that financial management is important at every stage of your business life. And this could be if you're starting up a business. You might think, okay, I'm starting up a business, or I don't really have too much income and expenses coming in. So why is there a need for me to have, financial management system? Or why is it important for me to even look at the finances? And we'll get to that. And when you're growing, it's especially important for when you're growing, because sometimes if you don't use the financial management tools available to you and you're not looking at your finances, you might be growing in the wrong direction. You might even think that you're growing, but in actual fact, you're going backwards. So, you'll find that at startup stage and growing stage, it's important to have control over your finances and just know where you're going inside of your business. And then also your established and mature businesses. And sometimes I think we as business owners, we believe that, no, if your business is big enough, then you don't really have to worry about your finances too much, because, everything should be fine. You've got enough reserves. But I would say that when you're established and when you're mature, if you don't have a robust financial management system, then you could end up losing big. And you could end up finding yourself in a space where, your business is no longer viable, or you are significantly out of cash flow, or you can't really make a quick plan in order to make sure that your business is sustainable going forward. So it's important. I mean, it's important when you start up, it's important when you're growing, and it's important when you are established or mature. It is impossible to make optimal decisions for your business based on operations alone. This only tells one side of the story. Now, what I found a lot of the times is that when dealing with business owners are usually very adept in making decisions with regards to their operations. So, for example, let's say you're a plumber, or you're a builder, or you do something in this industry specific. You're usually very, very knowledgeable about that industry, and you're very, very knowledgeable about what you're doing, but you're only looking at the operation side, and this is what operations need. And sometimes we don't look at, okay, what is the financial story? What is the financial part of my business that I need to take into consideration in order to make an optimal decision? Because a decision just placed or just made from an operational perspective is not always efficient. You have to look at it from different perspectives, and you have to include the financial impact and the financial implications of decisions. So if you do something that just sounds good for your business, so let's say, for example, a supplier tells you he's going to give you a discount, but you need to pay cash on delivery. You might think, okay, fine, I'm getting all my supplies cheaper. It should be a great thing, but depending on how much you buy, it might materially affect your cash flow that you can't continue anymore. So those are the type of things that we need to consider when making business decisions. So why is financial management needed? Financial management, it aids in cash flow management. And cash flow management, I mean, a small to medium enterprises, cash flow is the lifeblood of our businesses. We can't just operate on theoreticals and profit and debtors, creditors. We need money. We need money in the bank. And because we need to pay salaries, we need to pay expenses and so forth. So financial management is important so that you can be able to balance your cash flow management needs. And one of the key areas in terms of cash flow management is making sure that you get your money in before payments fall due. It doesn't help if you know a payment is due tomorrow and you wake up the night before the time thinking, oh shucks, I need to make a payment tomorrow, or tomorrow's salaries. You need to make a plan beforehand, or you need to do some sort of planning beforehand to make sure that cash comes in before payments are due. What else does it do? It maximizes profit. So if you use financial management tools correctly, you should be able to look at your business and say, okay, these areas that I'm operating, or these particular expenses that I'm incurring, it's maybe not necessary anymore. Maybe I need to reduce them. Maybe I need to relook at one of the smallest things, or that sometimes has a big impact in in your business, particularly small to medium enterprises, is bank charges. Sometimes, that's something that it's small amounts that go off your bank statement. And if you don't look at it on a monthly basis, then you don't know what your bank is charging you. And I mean, knowing banks nowadays, they don't call you to say, look, I mean, you're paying too much here on your bank charges. Let me shift you to a different package that's going to be more suitable to your business. Fortunately, that doesn't happen, or I have yet to see that happen. So if you're not looking at your figures, you're not able to maximize areas where you can minimize expenses and possibly increase your revenue. It mitigates risk. Risk mitigation is generally on onerous jobs. So if you get a job in and you don't do a proper due diligence, or you don't look at all the costs associated with running the job, you might find yourself taking on a job that is onerous, or that can lose you money if you don't do a proper financial projection on those jobs. What else helps with tax planning? And I mean, if there's any accountants or anyone that just came out of the February financial year, and you would know that tax planning is one of the critical things that that you need to do in order to either to minimize tax where possible, but also to avoid unnecessary penalties and interest. Also helps with cost control. So if you have say job specific costing, job costing or cost centers, you can then isolate those to say, okay, what is this particular cost center costing me? And what is this particular cost center costing me? And then try and manage the costs per cost center. And it also ensures readiness for investment or expansion. And I think that is a key question that we're going to look at later on in our presentation. So moving on, financial reports tell the financial story of your business. Based on where the story is going, you might need to make some financial decisions that critically impact how your story progresses. Now, I like to read financials, and I like to look at financials, and financials tells you a story. If you look at your your month to month performance, it tells a story. Is your revenue growing? Are you managing to make more sales? When are the busiest times in your business? Which times do you incur a bit more expenditure that you need to plan a bit more, and so forth? So if you look at your financial reports, it tells you some information that you're not necessarily going to get just by running your business and just by your day-to-day. You need to start to look at what financial trends are there in your business. Is your revenue increasing? Is your revenue decreasing? Is your profit margin increasing, or is it decreasing? Is your costs increasing without really passing on a price increase in order to maintain the same margins? So there's a lot of information that you can get by looking at your financial information. Ultimately, financial management aims to help you make better financial decisions, and that's what it's all about. That's the crux of what financial management is there for. It helps you take financial information so that you can make better business decisions, so that you can make better decisions for your business, so that your business can expand, so that your business can be sustainable, so that your business can outgrow the expected lifetime you might have. So it's a key component into running a business. Some business owners are unfortunate that they need to make decisions but don't have access to timely and quality financial information that aids in their decision making. And I see this a lot of times in businesses, where businesses are operating but they don't have access to financial information. And if you don't have access to all the information, then one would expect that your decision-making processes may be lacking in certain areas because you don't have access to the information. So it's important to gain access to the information. So what are some of the key financial management reports that we use? And some of these you might know, and some of them might be might be new, and I'm going to go through them in a bit of detail. But these are generally the reports that that can add value to your business. First one is annual financial statements, right? Annual financial statements, most businesses would have heard about annual financial statements. If you go and you look for funding, they will ask for annual financial statements. And if you prepare a tax return, you need annual financial statements. If you want to sell your business, they'll ask for annual financial statements. And annual financial statements, because it's prepared annually, it gives more of a summary look as to what did your business do per financial year. And annual financial statements generally include items like profit, like your statement of financial performance, which is an income statement, balance sheet, cash flows, notes, and accounting policies. So it's generally looked at on an annual basis, and usually gets prepared after your financial year. But it's something that you can't only rely on looking at annual financial statements, because it's only prepared on an annual basis. We have another report called your monthly profit and loss, and ideally you want to have your monthly profit and loss classified by revenue stream. So let's say you've got different operations. You're doing maintenance, but you're also building houses, or you're also selling products, and you want to be able to classify each revenue stream by its function, and then look, what is the profit and loss for each revenue stream? What did my construction sales make, and what is the expenses that my construction sales incurred? So that's your monthly profit and loss. And like we said, that is a bit more frequent, that you can look at on a monthly basis. And the profit and loss tells you some critical information. How much sales am I making? So that's your revenue, right? What are my direct costs associated with that revenue? So that would be called your cost of sales or your direct expenses. And those are generally the costs that you incur to make that revenue, the direct ones. And then we've got something called overheads. And overheads are generally your indirect expenses. Those are expenses that you're going to incur regardless of your volume, your operating volume of revenue. It'll tell you what is your salary and wages bill, how much salaries am I paying on a monthly basis. And then also, what is my profit or loss? And if we just want to put a bit of a equation in our mind, that's generally your revenue less your direct and indirect expenses and your salary bill. And then it shows you what you're left with after paying all your expenses. So if you can imagine this report in your mind, this is what is coming in, or this is the sales that I'm making, these are the expenses that I'm incurring. And ideally, what you want to see is that there's a bit of money left over on a monthly basis. So that's what you want to be able to see in your profit and loss. As soon as you start to see your trend is going downwards, and you see that your revenue is not sufficient to cover your expenses, then what it does is it shows you a red flag. It tells you, look, at some point in time, this is going to catch up with you. Now, whether or not that be in cash flow, or whether or not that be in running into profitability issues, it does give you a red flag, and it's important for you to be able to pick that up timelessly so that you can make some corrections if necessary. An example of this that I came across is we implemented some management accounts for a company that I think they were running for about 5 or 10 years. And first time we implemented management accounts, you realize, shucks, he's spending way too much on salaries. His salaries is about 98, 99% of his revenue. And he didn't know. All he thought was his business is not doing well. He's bleeding cash. But eventually, once he knew where the problem was, he was able to then take corrective action. So that's something that you need to be able to see, and you need to be able to identify what are the problem areas in your business to make sure that your business continues sustainably. Then we've got the balance sheet, right? Balance sheet is a bit difficult to sometimes understand, but all it really shows is what assets does your business have. So what are the business assets? And that could be cash, debtors, vehicles, machinery, any of those sort of things. And then what liabilities do I need to pay? And the balance sheet, once again, is produced at a particular point in time. So it just gives you a snapshot of this is the assets you've got, this is the liabilities you've got as at that date, right? And your liabilities, like I said, that could be loans, if you owe people money, creditors, if you owe your suppliers, and then if there are any tax liabilities or VAT liabilities and so forth. And then the last section of your balance sheet is just essentially the net value of your business, which is known as equity, or assets less liabilities. And so this is just a very, very small summary of what are the key financial reports that you want to have inside of your business. There's a few more, which is really value add as well. Debtors age analysis. So your debtors age analysis really tells you who owes you money and for how long is that money outstanding. And this is quite an important tool for cash flow management. If you know you told the customer you need to pay me within 30 days, and after 30 days the customer hasn't made payment, I mean, you need to be on your customer, because what normally happens is the longer your debt remains outstanding, the lower the chance that you'll actually recover that money. So it's important to try and jump on it as quickly as you possibly can, depending on what terms you've given your customers. So if you give them 30 days, on day 31, you actually want to be giving them a call to say, where's the payment? Because at the end of the day, the longer you leave money outstanding, it's money that could have been in your bank account and you could have been earning some interest on there. Creditors age analysis. This is another important one. It's who do I need to pay in the short term? So who are the people that you owe money to, and for how long do you owe them? And it's important to make sure that you keep your suppliers within the agreed credit terms. Otherwise, eventually what happens is if you delay in paying your suppliers on time, eventually they don't want to supply you anymore. And when you do call on them and you do need them to supply you something on credit, they might be reluctant to want to do so. So it's important to make sure that you're keeping that at the back of your mind, and keeping that, because it also tells you when do you need to pay the suppliers and when do certain amounts fall due. And then also we've got a variance analysis, and this is generally if available. So generally, if you've got a budget that you're using, the variance analysis will tell you, according to your budget, this is what you've projected, and how did you actually do? How did you actually do in comparison with your projection? So that gives you also information. Then we go on to the next topic, which is budgeting, right? And I'm sure everyone has heard of budgeting. Some of us might have been looking out for a budget speech last month that we didn't get. So, but we'll hopefully get it this year or this month, and hopefully it will be quite robust. But budgeting is important, and as much as it's important on a government level, it's also important on an SMME level. So, what is budget? What is a budget? And a budget is one of the key tools in your business toolbox, and this is one of the most important things that businesses can have, because without a budget, you don't really know where you're going, and you don't really have an expectation as to what is it that you're going to do. So what is a budget? The budget is an estimate of your expected sales, costs, and overheads. So essentially what you do is you sit down and you think, okay, if I do this, this is how much I can make. These are the costs that I'm going to pay, and these are the overheads I'm going to have to maintain. Right? So that's in a very simple way. That is what a budget is. But what does a budget cause you to do? And this is what we really want to look into. So budget forces you to develop expectations and consider the financial implications of doing something. And this is I think the importance of this cannot be understated. For every business that you operate, you need to be able to develop expectations. And developing expectations is you need to think about your business, and you need to think, okay, if I sell one of these every day at this price, this is what my sales is going to be. If I do this, this is what my cost is going to be. If I do this, and then in your mind, you kind of have an expectation as to how your business operates, but it also gives you a very, very good insight as to what are the financial results that you should be expecting if you do things that way, right? So the important thing is here that you need to be able to develop expectations, but also consider the financial implications of what you are doing. It gives you a tool to monitor, right? To monitor and guide your decisions. So if you have a budget, you can always look at, okay, this is what my budget says. This is what my actual results say. Maybe I need to amend something. Maybe I need to make some decisions. It gives you insight on if you should go in a particular direction, or, it answers the question of, is it worth it, right? So a lot of the times opportunities get put in front of us, and we look at the opportunity, and on the get-go, it looks fantastic. It looks like a really good opportunity. But once you start to really dig into your budget and you prepare a budget and you say, okay, but I can render this service, but it means I need to get a machine from the other side of the country. If I get this machine, it costs me X amount, but the transport cost of getting this machine to me, to where I am, is going to make this project not feasible. So it really gives you an opportunity to delve into the specifics and delve into the key decisions that you need to make inside of your business. What else does it do? It gives you a tool to monitor performance. So if you've got a budget and you compare it to your actual results, you can see, okay, I budgeted X amount. Did I exceed my expectation, or am I under? And what are the things that I need to do to help me reach my budget, or help me reach my projections? It helps you identify wastage and adapt your expectations, and this is what is called flexing. So a lot of times when we prepare budgets, and when circumstances inside of our business change, we need to be able to flex our budget as well. And if we just look at budgets in isolation and we believe that they should remain fixed and they should remain stagnant, then we're not using the budgets as an effective tool. So budgets need to flex, and they need to adapt with changing circumstances. So if your budget for salaries, for example, is 100,000 and you employ more staff, you can't say my budget is going to remain at 100,000. You need to flex your budget, or you need to adapt your budget to take into consideration the changes in your environment. Right? If certain costs increase, then you need to make provision for that. What else is there about budget? What are the most common types of budgets? And I'm only going to mention 3 for the sake of time. The most common types of budgets is a zero-based budget. So a zero-based budget is where you start from scratch, right? So you look at your business as if it's a blank sheet, and then you start to populate. You start to look at what are you doing, how are you operating, and you start to put the various costs, and you start to put the various sales in from scratch, and you look at your business as if it was a blank canvas. Then you've got an incremental budget, and this is what most people do sometimes, is they take last year's budget and they add or subtract by a couple of percent and so forth. It's not in my opinion, it can be helpful, but it's maybe not the best way to prepare budgets, because percentages don't always give you the true reflection of what your business is doing. The one I like to use is this one. It's called a rolling budget. Now, a rolling budget is a budget that is prepared for a certain period, but then you update it. So if you see, okay, certain things are changing inside of your business, you roll it to a particular, let's say it's a monthly budget, then you take your budget and you update it with the latest figures, and then you adapt it. And then you monitor it going forward. So it keeps rolling forward. It keeps adapting. It keeps changing with the environment inside of your business. So that's a nice one to implement. And I just want to make a key distinction here between budgets and cash forecasts. Now, sometimes when we look at budgets, we think budgets and cash forecasts is the same thing, but it's not really the same thing, in the sense that budgets generally account for profit and loss. So that is invoiced expense, invoiced sales, expense invoices, and so forth. Whereas cash forecasts are generally isolated to what is the actual cash inflows and outflows, which we will touch on next. All right. So what is cash flow? Right. We can ask that important question. So cash flow, or cash, is the lifeblood of a business, and the business needs to generate enough cash from its activities so that it can meet its expenses and have enough left to pay to repay investors and grow the business. While a company can fudge its earnings, its cash flow provides an idea about its real health. So, for example, if you have a business and your business on paper is doing fantastic, you've got all the profit, but you've got no money in the bank, then you're sitting with a problem. It either means that all your cash is tied up in maybe inventory or maybe debtors, or it's tied up in things that don't allow you to actually pay for things. Then you're sitting with a problem. So it's important to have a healthy balance between profit, but also have cash available. And managing how your cash flows out and how it comes in is one of the most critical components inside of your business. So what is cash flow management? Cash flow management is the process of monitoring, analyzing, and optimizing. Keyword here is optimizing the inflow and outflow of cash within a business. It involves ensuring that a company has sufficient funds available to meet its financial obligations, such as paying bills, salary, and loan repayments. And this definition came from Shopify. I think it's really a good definition to look at. And as SMMEs, I'm sure we've had we've come to situations where you need to pay for something and there's maybe not enough cash in the bank. Then you've got to quickly call a debtor, or you've got to make a plan, or you've got to get some money from the bank, or make a plan in order just to pay your debts as they fall due. Now, cash flow management, what it does is it helps you make sure that you can pay your debts as they fall due, as well as your expenses. So cash flow management is not a passive process. And I want to underscore that cash flow management is not passive, in the sense that even if you have a system, it doesn't necessarily mean that it's going to work. You need to be involved. You need to look at your cash flow management strategy. Just because you're sending someone an invoice doesn't mean that they're going to pay. And then, that's a funny reality, because you think, okay, now if I send my client the invoice, they're going to pay within the terms that I allow. Sometimes it doesn't happen. So you might need to be involved. You might need to offer them some incentives sometime as well to pay a bit earlier. If you've got some expected expenditure that you need to pay, that you're not really sure where the money is going to come in at that particular point in time. So cash flow management is not passive, it's active and requires involvement. It requires involvement, and it requires you to be kind of on the ball, if I can use that expression. It's a process with steps that needs to be optimized in order to get the best results. So, like I said, the fact that you have a fantastic invoicing system doesn't necessarily mean you're going to get paid on time. So cash management. Let's have a look at that. So due to the nature of SMEs, we normally don't have extra cash or easy access to finance or significant assets that we can use to borrow for cash or borrow against for cash. And we need to create a greater focus on becoming cash savvy and making sure that there's money in the bank to continue operations and thrive, because a creditor is not going to accept an IOU. A creditor requires cash or money to be paid into their bank account. I'm not sure if anyone has got staff that is willing to be paid on IOUs or letters of commitment. They need cash because they've got bills to pay, right? So it's important that when we look at our cash management, we develop a robust cash management strategy to make sure that we get the money in that we need to have before we need to pay it out. Right? Cash flow must be tracked and managed to make sure that you always have enough money to pay salaries, expenses, debts, and so forth. And it's important to track when money is coming in and when money is coming out, or when money is going out. So the when is the key here. Right? And I've just got a quick template on how to go about doing a cash forecast. So the first thing that we need to do if you want to do a forecast is determine your forecast period, right? So are you going to do a forecast for a couple of weeks? Do you want to forecast for days? Do you want to forecast for months? Or do you want to forecast for years, right? Common periods include 1 to 3 years, but it can also be shorter. So if you want to do a three-month cash forecast, you can. All depends on what your business needs and what information you want to see. So once you've got your forecast period, first thing that you need to do is you need to add your opening cash balances. So this is how much money do I have in the bank at the moment, or how much cash do I have in the safe or in the bank account, or how much cash do you actually have to start with. Then what you want to do is you want to add your expected sales income. And the key thing to note here is this is not invoices that have been generated, but what you want to do is you want to factor in when invoices are actually going to be paid, or when you're expecting them to pay, right? So if your terms are 30 days, you should be expecting last month's invoices to be paid this month, that sort of thing, right? And then we've got to add your other income or your non-sale income that you might have, right? So this is if you're getting any grants coming in, anyone paying you refunds, or SARS paying you refunds. Are you getting any sort of investment income? So it could be interest, or maybe you've got a rental property or something like that. Any loans that might be approved that will pay in, or that will pay in at that particular point in time, or if there's any asset sales that you might, any assets that you've got that you're selling that is going to pay out. So this pretty much gives you a summary of what money you're expecting in from sales and what money are you expecting in from other avenues other than sales, right? And then you want to total your sales and non-sale income, and that'll give you a total of what you're expecting to get in during that month. And then you want to subtract all your expected outgoing cash, right? And this could include items such as rent, salaries, supplier payments or purchases, could be asset purchases as well, loan repayments, bank fees, telephone, vehicle expenses, and so forth. So pretty much all the money that you're going to spend, that you're expecting to spend, or that you're expecting to go out of your bank account or out of your cash kitty. And then you want to calculate and evaluate your net cash position. So if I take all the money that's coming in and I subtract all the expenses, what am I left with? Am I sitting with a negative, or am I sitting with a positive? And then you want to carry that closing cash balance forward to your next period, right? And obviously you can't carry forward a negative cash balance unless you've got an overdraft. Right. So this is just a quick forecast example that I just want to show, and it just gives you a rough summary. And this I got from once again from Xero's website. You can go into Xero's website and you can type in cash flow forecast. There's a section where they just ask you to put in your name and your email address, and then they send you this forecast for free. So this is a nice template to use as a starter. It's not a one size fits all. So you might need to adapt this. You might need to add other elements in, and you might need to subtract certain things. But this gives you a nice, how can I say, a nice overview of what you should be having in your cash forecast. And you see the key things there are the date, the time period, and then you've got it per period here. So this is just a snapshot of what a forecast example might look like. Right? Then we've got some tips with regards to the forecast. When you're doing forecasts, always be realistic. Always be realistic. You can also have two additional forecasts, which is a best case or a worst case scenario. So this could be, when I'm doing my forecast, my best case is, okay, all of these guys are going to pay, and this is my worst case scenario. These guys are not going to pay, or I'm not going to get that cash in. So do a best case and a worst case scenario, but try and be as realistic as possible, right? You can use your financial history as a starting point. If you don't have, then you're going to start from scratch. You're going to do, your zero-based budget. But you can use your financial history as a starting point, and that will really kind of tell you, what do you need to add in and where do you need to go from here. Customize your forecast to suit your individual needs and circumstances. And I can't emphasize this enough. Each business is different. Each business has got different needs, different circumstances. So customize your forecast. Make changes where need be. Put in whatever you feel your business needs, and your business that involves your business. Put that into your forecast, right? Flex your forecast. So your forecast should flex and adapt to changing business conditions and environments. So, if you're expecting, if you're doing a cash budget and you're expecting maybe VAT to go up, then you can put in the circumstances of, if VAT does go up, I'm going to need to physically pay my supplier X, but I will maybe only get that VAT back, in a month or in 2 months, for example. So flex your forecast, make your forecast alive, and use it as a tool to help you make better decisions. Compare your forecast to actual performance, and then what you can do is you can update your forecast. So either look at your performance and make some decisions on there when you compare the two, and then use that to update your forecast if your forecast is no longer relevant or is no longer accurate based on what your current business operating environment is. Make provision for seasonality or trends. So January could be a slower month, for example, for customer payments. And I think we've all got the January blues. So generally January and December is really not good months for businesses that are not holiday based. Some firms and some entities close. I mean, even us, we close over December and beginning of January. So we need to make provision for when things start to slow down. You need to maybe have a bit of a kitty available to be able to continue to pay what you need to. And then you can refer to terms given to customers and clients. So if you give them 30 days, put that into your forecast as if they're going to pay on time, for example. Suppliers, put that in, your terms that you've got with suppliers, put that in so that you can account for when you physically need to make those payments. Right, some forecast tips: account for abnormal items such as extra pay periods. If you're paying your workers fortnightly, sometimes that extra third pay period in a month can be a bit hairy. Annual payments like tax payments, for example, VAT and tax payments as well, every 2 months or every month if you have a business of that size. Include a bit of savings, and then also some step up or growth expenses. So let's say, for example, after 6 months, you expect your turnover to double, but if your turnover doubles, you need to have double the staff, for example. Then put that into your forecast, right? But then include everything that you need to do in order to get that staff up and running. Maybe you need to buy PCs, maybe you need to buy desks, or maybe you need to buy seats, maybe you need additional subscriptions and so forth. Right? What are some of the benefits of accurate forecasting? Helps with decision making and answering such questions as, are the credit terms I am issuing affordable for my business? Because remember, just because another business is doing something doesn't mean it works for you. Should I or can I afford to be issuing credit at all? And is it normal for my industry? Am I covering my expenses? How much cash do I need to bring in? Do I need additional finance or working capital? Or am I going to be able to pay salaries? The daunting thought. Right? And it helps you manage working capital correctly, facilitates growth and stability, and helps you identify potential savings or investment possibilities. Right? So I'm going to try and go just a bit quicker because there's a section that I want us to just chat about at the end of this presentation. Facilitates on-time payments of accounts, leading to better supply and credit relationships, right? So you can see there's quite a few benefits of accurate forecasting, right? Minimizes ad hoc or suboptimal decisions made in haste. So this could include, emergency high interest loans, having to go to places that's going to charge you exorbitant interest rates and eventually cripple your business going forward. Facilitates long-term planning, crisis and risk management. So places now planning for low cash periods. So let's say, like we said, say your business is seasonal. Once the season is over, then you will probably find a reduction in your business, in your business operations, and therefore you need to plan a bit for those periods. Helps you determine affordability for loans and expansions. And the key thing that I just want to hop on here is that affordability for loans and expansions. In order to take out loans and get expansion capital, you need to afford it, right? Reduces stress and anxiety. And if we could all live stress-free and everything is going fantastic, in order for that to happen, it requires a bit of planning and sometimes a bit of financial savvy as well. Right? Now, I just want to quickly jump into funding. So what general funding options are available for SMEs out there? You could have a term loan. So term loan is, the bank tells you, here's money, you need to pay me back over 5 years or 10 years, whatever the case may be. You can have overdraft. So overdraft is a revolving facility that the bank gives you. They say, look, you can use an overdraft. You have an overdraft of 10,000, which means you can overdraw your business account by 10,000. You've got credit card, and I think we all know what that is. Personal loans, and this generally gets done by the owner, and then they go take out a personal loan somewhere, and then put that into the business in order to fund a particular expansion. But generally, personal loans are quite expensive in terms of interest rates. We've got revolving credit plans as well. So those are options that generally banks give you. They say, look, we've got a facility of X amount. Once you've paid back about 85% or 15%, then you can draw down on the facility again. Bond finance. So this is now bonding against your property. It's generally the cheapest sort of finance, but if you don't pay it back, then you're at the risk of losing your house. So that's very risky, but probably something that some people do use. And you've got equity finance or investor finance. So this is getting on partners that buy shares in your business, and they just want a particular return from your business or return from the investment. That tends to be the most expensive. And then loans from friends and family, and that is probably the most probably the cheapest in your mind, but it also comes at a cost. Because for example, let's say you make a loan from one of your family members, and they're comfortable with giving you the loan, you're operating, you're doing well, you're making your repayments, and circumstances changes in the family member's life, and all of a sudden they need access to that money again. Are you able to pay that? And what sort of impact is it going to have on your relationship with your family? So those are other things to consider outside of just the normal operations. We've got grants. Everybody likes free money sometimes, and grants, sometimes there are institutions that will give you grants for certain things, and those are not repayable. And then you've got crowdfunding, which is where there's some sites where you can list your business idea and you can get individual people to buy into your company on a smaller basis, but then either you need to give them part of your entity, or you need to give them a particular product, or those sort of things, right? So these are, these are the more widely known funding options that's available to SMEs, right? So key questions about funding: why do you need the funding? I always ask that question. Is if you say you need funding, the question is why, right? You always need to be able to justify why you need the funding. And the second question is that if the funding is given, can you afford it? Because there's always a cost to funding. It could be loss of control. It could be interest payments. It could be having someone around the table that now all of a sudden is making decisions, and you can't really make decisions as quickly anymore, because now you've got other investors, you've got people that want control, that sort of thing. So you gotta be aware of the cost. Big funding no-no, and I want to spend a bit of time on this, is obtaining funding to keep you going. If you can't build up a reserve at your current levels, how are you going to pay back the funding? Because remember, what happens is now, if you are obtaining funding just to keep you going in the same capacity, if you couldn't build a reserve while you were operating, then how are you going to all of a sudden increase your business operation so that you are able to now pay back the funding? Getting a working capital loan or overdraft or something like that just to keep you going is usually not a good idea, because what it's going to do is it's going to put you in a hole, and it's not going to put you in a position where you need to sometimes confront your situation and make some big changes in order to make sure that you are able to continue going forward. And sometimes having funding or money coming in just to keep you going exactly the same way is usually not a good idea. Right? Responsible funding would include options such as working capital finance. So this is for bigger projects. So let's say you've got a project, the project is in the bag, you just need some money to cover your first month or your first and second month's operations, then you're going to get it back. That's a good way to use funding, because you're investing that funding into increase of profitability or increase in cash inflows. Or growth expansion finance. So this is a key component that requires you to make more money, right? So if you need more money to, let's say you're going to take on a big project and you need additional staff, but you need to get a bigger office, you need to get more staff, but you maybe just don't have the cash right now, but you know that the business is coming in, then that's a good idea. Or asset finance, if you're renting something and you've got the opportunity to purchase it and it's going to drastically reduce your cash outflows, maybe that is something that you can look at as well. And then when preparing funding applications, you need to show key data to investors or funders, historical financial information. So they want to know, okay, how have you been doing? So what have you been doing over the last couple of years to get an indication as to, what sort of business am I looking at investing in? Why do you need the funding? The why is important, and how is it going to help you? Now, you don't want to tell a funder, oh, I just need money so that I can continue to operate. No, a funder is not going to be intrigued by that. A funder wants to know, if I give X amount, how is it going to increase your capacity so that you can pay me back my money plus a return, right? So that's the key thing that you want to take cognizance of. You need to show that you can afford the repayment comfortably, and so going for funding, but not taking into account in your cash flow the effects of having to repay that funding is, and not showing that in your funding application is going to get you turned down. Realistic projections and targets. So this must be achievable from the perspective of the founder, and be ready to defend your position. So if you say, if you give me 500,000, I'm going to double my turnover, funder will ask you, show me how. Show me exactly, show me the plan, right? And funding applications generally require business plans, and those business plans detail how exactly are you going to go about achieving that, that double revenue, so forth. So you want to be realistic, and you don't just want to paint a picture that looks all rosy, but you can't deliver. So you have to, it's always good to present a picture that you are comfortable that you can deliver. And that doesn't give you sleepless nights. Right. And then lastly, some financial systems that we can look at. So ideally, your financial records need to be available at least monthly, but also at the time decisions need to be made. So it doesn't help if you need to make financial decisions, but you're only going to get your financial reporting 2-3 months thereafter. It's not going to help you when you need to make decisions. Best practice require that your financial reports are captured, processed, and reconciled on at least monthly basis, especially when you're VAT registered. For those businesses that are VAT registered, you need to have a good idea as to what your expected VAT payment is going to be, because the VAT can sometimes mess with your cash flow, or most of the time it messes with your cash flow. So it's important to know how much you need to pay well before the time, so that you can make sure that you've got money available to do so, because the penalties and the costs of non-compliance, they are quite high. Financial software should always be complete in its operation. So ideally, you want it to be integrated on the same system. So you want your invoicing, your banking, your purchasing, all of the financial elements to be on the same system, and it must have robust and appropriate reporting. So it doesn't help if you have a system that does your invoicing, you've got another system that does your payments, you've got another system where you process, you've got an Excel spreadsheet where you're summarizing your expenses. There's too many moving parts, and it needs to tie into tell you the the bigger picture, and give you an accurate reflection as to where you are exactly. So any sort of financial software you use should be complete. Recommended, I mean, at this in this day and age, cloud-based accounting systems are generally quite easy to access, and they are generally robust in their features. I mean, you've got options such as Xero Accounting, Sage One, QuickBooks Online, and some additional ones like Zoho are becoming popular now as well. So this is just a snapshot of the type of financial systems you get out there. And lastly, I just want to say this is just a very high-level summary. You need to look at your business, and you need to consult an expert to give you tailored advice to what will work for you. But these are just general good principles to have in your business. And it can help you take some baby steps into getting more robust with your financial management strategy. And I think we are done. Sorry for the rush at the last end, but we had to get through the source material. So I think, Tim Kula, I think if we can jump into some questions,
Thank you.
if there are
Thank
any.
you. Yes. Thank you so much, Newton, for that very thorough presentation, very detailed as well. I'm going to open it up to questions. Maybe we can take up to 3. So if you do have a question, please raise your hand, a question or a comment. Please raise your hand and then we'll attend to your question. Or type it in the chat if maybe you're too shy to unmute and ask the question. So questions going once, going twice. I don't see any hands. Okay, Anempo Health, Tembi, you can go ahead.
Good afternoon, everyone. Thank you for the interesting topic. So you mentioned the 3 types of, I just forgot the name. There's revolution, there's starting on a clean slate, something to that effect, as you're doing your financials. Which would you say, if the business is still new, would start on a clean slate, or when the business is older, can I opt for that option to say, okay, I'm starting my financials on a clean slate and I'm moving forward, this is what I'm going to do? Or is that option applicable to somebody who's fairly new in the business world? I'm not sure if my question makes sense.
I think I've got it. So you must just tell me if I'm right, and that had to do with the budgeting, right?
Yes.
Yes. So I would say if you're new in the business, it's always good to do a zero-based budget. So to start from scratch, because you can't do an incremental budget, or you can't do a rolling budget because you don't have history. But if you and you might find maybe you're spending a bit more than you should. You haven't really gotten into the rhythm of doing business yet. So I would say that a zero-based budget, starting from scratch, would be a good idea to start with, because it helps you think about the elements of your business and then see whether or not can you afford certain items based on a particular revenue level. So if you know you're only expecting 10,000 rands worth of sales, to be very difficult in month 1 to consider leasing a premises for 7,000 or 8,000 rands worth of rent. So a zero-based budget would be good for startups to look at. I hope that answers your question.
Yes, it does. But would you also advise it on somebody who's been in the field for a longer time? Maybe I've been in business for 3-4 years. Can I start from zero budgeting and move forward?
Yes, definitely. Look, zero-based budgeting. I think what the nice thing about it is that it gives you an opportunity to look at things with new lenses, or look at your current financial performance and do projections and budgeting going forward, just looking at your operations alone. So a lot of times businesses, we sometimes build bad habits. We incur expenditure that we shouldn't be incurring. And if we just keep loading on those expenditures, we don't have an opportunity to look at those expenditure and ask ourselves, is this even necessary? Is it a good idea to do this? So sometimes every now and then, maybe even once a year, or when you feel it's necessary, it's also good to look at, to start from scratch again. I mean, I've done that myself a couple of times. Re-look at my strategy, re-look at my budget going forward, and then look at it from a new set of eyes. And sometimes you will realize that there's maybe certain things that you don't need. So definitely can add value at certain points in time. I don't think it helps doing it on a monthly basis, but it can help from a periodic perspective.
Okay, thank you so much.
No problem.
Thank you, Tembi, for your question. Any other question? I'm cognizant of time. We are We have run over quite a bit, so maybe one more question. If there isn't a question, then I will hand over to you, Newton, just to give a closing remark, and then we'll conclude the session. I don't see any hands. So Newton, you can just give close us off with just closing remarks on the session, and then we'll close.
All right. Thanks, Tim Cooley. Yeah, so I think I'm hoping that everyone has maybe taken one or 2 points, because it is quite a comprehensive, and there's a lot of detail in there. And I believe Mido has recorded the session, so if you do want to go into it, I think it's probably available on the platform. Tim Kulu can probably advise us regarding that. But I do want to encourage all the businesses, whichever, doesn't matter which stage you are in. It's always good to have access to complete financial information, and in order for you to make better business decisions. If you are making decisions without taking into account the financial effect, then I would say that it's going to catch up to you. So I would really encourage all businesses. And remember, you don't need to be a financial expert. And I think business owners sometimes, they judge themselves very harshly, in the sense that they feel that they should know everything. I mean, even I don't know everything. I only kind of really know my field, and maybe a bit more than that. But if I need assistance, then it's always good to to tap on the resources that are around you. So speak to an accountant, speak to someone that can help you with these things, because I can guarantee you it will help you make better decisions for your business, and hopefully grow your business and make sustainable decisions, so that your business can last very, very long, and maybe you can sell it in the future. So I think that is it from my side. Thanks once again to Mido for allowing me to present this. And I hope and I trust that everyone has gotten something out of it, and that it was worthwhile to attend. Thank you.
Thank you. Thank you so much, Newton. And thank you to everyone who took the time to attend the session. As Newton mentioned, this session was recorded and will be uploaded on our digital platform, Lemmy. So if you'd like to refer to anything, or maybe you feel like there's something you want to go over once again that maybe you did not understand clearly the first time around, the recording will be available for you to access on the Lemmy app/platform. You will receive communications tomorrow afternoon once the recording has been uploaded. Otherwise, I'd like to thank everyone for your time, and we look forward to seeing you at the next workshop session, which will be next month on the 3rd of April, where we will be talking all things brand building with a brand builder and Mido senior manager, Pimelo Sirwe. She'll be talking about your brand identity. How do you communicate your brand to your ideal customer or client? She's the expert, so she will unpack it better than I will. Otherwise, thank you so much for your time. Wishing you an amazing evening and a wonderful weekend ahead. Thank you.